So I'm going to talk about the individual provisions of the One Big Beautiful Bill Act, and sometimes we like to call it OBBA. The first thing that I want to talk about, though, is a lot of the changes that were part of this tax bill go back to the Tax Cuts and Jobs Act, which was passed in December of 2017 and kicked in for 2018 tax years. Some of the biggest provisions in that Tax Cuts and Jobs Act had an expiration date on them. And some of those major provisions that affected every taxpayer expired at the end of the 2025 tax year. So some of the key things that happened in the OBBA really are removing that deadline of the end of December 2025 and making these tax provisions permanent. So let's talk about a few of these key provisions that got extended with the OBBA that relate to individuals. Probably the broadest application for all individuals was the tax rates. So the Tax Cuts and Jobs Act cut tax rates for all individuals, regardless of income level. The OBBA takes away that deadline of the end of December 2025 and makes those rates permanent. So we are dealing with the same tax rates in 25, 26, 27 that we were dealing with since 2018. So nothing has changed other than they are now permanent. The child tax credit with the Tax Cuts and Jobs Act got increased to $2,200 for children under the age 18 that were claimed as a dependent. This is made permanent with the One Big Beautiful Tax Bill. Some other items that relate to go back to the Tax Cuts and Jobs Act are really the itemized deduction area. This is where there's some permanent extensions and some tweaks that will provide some planning opportunities. You guys might all recall that the standard deduction basically doubled for all individual taxpayers back in 2018. And that really took a lot of people out of itemizing deductions. That was going to expire after the 2025 tax years. So now the OBBA, that bill has made that permanent. So we have that higher standard deduction. Before the Tax Cuts and Jobs Act, we had a haircut, I'm going to call it a haircut, on itemized deductions. We lost a certain percentage, 3%, of our itemized deductions based on our adjusted gross income. That was taken away with the Tax Cuts and Jobs Act, and so we've been having no limitation right now on our itemized deductions. The One Big Beautiful Tax Bill did add a new limitation or new, haircut on itemized deductions for those who do itemized. Starting in 2026, if you are in a top tax bracket of 37%, you will only receive a benefit of 35% of a deduction for your itemized deductions. So instead of getting a 37-cent tax savings for every dollar, you're only going to get 35 cents. The next item is a big one, and this was very, very contentious as this bill was going through the whole process of being passed, and it's the state and local tax limit, and we refer to it as a SALT cap. The Tax Cuts and Jobs Act severely limited the amount of deductions that individuals could claim and take for state taxes, including income taxes and real estate taxes, at $10,000. Whether you were married or whether you were single, it was $10,000. Starting in 2025, so be aware of that date. That's a very important time frame, 2025. That SALT cap has now been raised to $40,000. This is only around for 25 through 2029. We'll see what happens at that point, but this is also another planning opportunity, and I'll touch on that in a minute. The last bullet point on this slide has nothing to do with the Tax Cuts and Jobs Act, and it's a deduction for seniors. Seniors, for this purpose, is defined as somebody who is age 65 and older. They will receive a $6,000 deduction if your income is below certain amounts, and that is $300,000 for a married filing joint couple. And this provision applies for 2025 through 2028 tax years.
So Terry, we have unpacked so many different areas related to individual income tax provisions. I know there's also estate tax areas. Let's get into some of those estate tax and just even financial planning implications here.
Sure. So the estate tax exemption, which is a lifetime exemption, which is the amount of giving that you can do during lifetime and what you can pass to heirs at your death, has been a topic of conversation. And while it doesn't affect a lot of people, when you look at the percentage of people who would be subject to the estate tax, it does affect some people. And the amount of giving right now that you can do at lifetime and at death is about $14 million. And that was going to expire and go back down to about $7 million in 2026. The One Big Beautiful Tax Bill made that higher amount permanent, reset it at $15 million, and will continue to index it for inflation. So kind of a reset at $15 million, and then going forward, continued for inflation. Now, one of the more interesting things I think that came into this tax law is something called the Trump account. And something very new, has nothing to do with the Tax Cuts and Jobs Act. And this is basically kind of like an IRA account for children who are under the age 18. For children under the age 18, a contribution of $5,000, which is non-deductible, can be made as long as that child is under the age 18. Distributions are not allowed until the child is age 18. And then the earnings portion of that distribution is ordinary income, which isn't the greatest tax rate that can be obtained. I mean, a brokerage account might be a better way to save money for a child. There's two interesting parts about this. And first of all, we need a lot more guidance from the IRS in terms of how these are going to work. And in fact, the law says no Trump account can be open for 1 year until after the bill was passed, so 1 year from the date of passing. But two interesting things, and I got it on the slide here. So for children born in 2025 through the end of 2028, the federal government is going to fund their Trump account $1,000. And there'll be a mechanism on income tax returns, we believe, that will trigger this funding. And I did some math, and if you deposit $1,000 today and let it grow at 10% tax deferred for 65 years, that account will have $490,000 in it. Obviously, with pure just inflation and sitting in a bank account, it would earn something. But $1,000 today, $490,000, 65 years from now, that's pretty impressive.
To just start to summarize this for us, because you talked about so many great changes, but with all these changes, there were a lot of different phase outs that came into play here and limitations, which also means scenario planning and modeling. So wrap it up for us. What are some proactive ways to manage itemized deductions?
First of all, that state and local cap of $40,000, that kicks in for 2025. And there are phase-out ranges on that based on income. And so we want to take maximum advantage of that $40,000 that individual taxpayers have. And so making sure we hit, the $40,000, if we can, get it because our income is low enough, we definitely want to target that in 2025. The two things related to contributions, one, that 0.5% haircut, and the 35% benefit for itemized deductions when we're in a 37% tax bracket. Looking at the timing of contributions, there might be a very big advantage to making some large contributions in 2025, charitable contributions in 2025, so that there's not as many haircuts associated with those deductions. And so one of the ways that people might look at doing that is by doing a donor advised fund, which is a very low administration way of kind of having a private foundation. So itemized deductions is going to be a big planning opportunity for us in 2025.